Hey everyone, and welcome back to another portfolio update. So basically this is it right now. The last Monday portfolio, couch investing portfolio, is up 4.5% compared to the S&P 500. It's only up 1.39%, but don't cheer just yet, because since the start of this challenge, the portfolio is up 6.7%, while the S&P is up 13.14%. So definitely underperforming right now. And for those that didn't know, this is a portfolio that started at the end of February. Again, it's a long-term thing, so we'll see how things evolve. And this is not my main portfolio. Of course, I did not start investing at the start of this year. I started in 2016. My main portfolio is much more stable than this one. Now, what has happened with the position since the last time we looked at it? So Tesla still number one here. It's up 27.78% and is about 18.7% of the portfolio. PayPal is the number two position here, 16.23% of the portfolio and up close to 20%. Palantir is 13% of this portfolio and up 56%. SoFi is 12% of the portfolio and only up 3.21%. As for Google, 10% of the portfolio and also up by 10%. And then we're moving towards the more reddish positions. The local number 6 here, that's 5.5% of the portfolio. Again, look at the big difference between the gainers basically and the big positions. And then once we reach outside of the top 5, it's smaller positions. So despite them being down quite a lot, it's not dragging the portfolio by that much. It's dragging it down definitely, but not as much as, well, it would be a 10% position or a 20% position, something like that. So the local is 5.56% of the portfolio. I'm down close to 16% on that. Meta is a 5% position in the portfolio, up close to 20%. Intel is 4.25% of the portfolio. I'm down 33.9% there. Lululemon, 4.12% of the portfolio, down 21%. Rocket Lab, yes, I know. Do I have regrets? Yeah, of course. I would have loved Rocket Lab to be 100% of the portfolio because it is up 72%, but still a long way to go. Only 3% of the portfolio, but we're up 72% already on that position. I will have no issues adding to Rocket Lab in the future, despite being up a lot. Yes, of course, my average price will go up, but hey, so be it. Celsius is only 3% of the portfolio, down 33%. Snowflake now 2.77% of the portfolio, down 4.2%. Then we've got here Accelera, only 1% of the portfolio, and we're down here 43.5%. Again, with Accelera, for example, it's either it works, then I'll be green triple digits probably. And if it doesn't, then it doesn't. It's only 1% of the portfolio, so who cares? Now, I did add a little bit of Intel and I did sell a little bit of Snowflake to put into Intel. Other than that, didn't do much with the portfolio, and I plan on waiting and seeing how these things work out. So basically, if you only came here to see what's happening with the portfolio, this is basically it. And to be honest, yes, of course, I would have loved to be up already double digits, but I think we still have time. I think there are still here, especially PayPal, for example, and SoFi, number 2 and number 4 of the portfolio. I still think that when these positions move, then I'll probably outperform. But we'll see what happens. We'll see what happens. I can, of course, be completely wrong, and that's, well, not fine, but that's just the way things are here. Whether I'm up or down, you'll be seeing that in the videos. As for some macro news, so China August unemployment rate rises to 5.3%. The estimated number was 5.2%, and the previous one was 5.2% as well. China retail sales rise 2.1% year over year. Estimated number was 2.5%, and the previous number was 2.7%. China industrial output rises by 4.5% year over year. Estimated number was 4.7%, and previously it rose by 5.1%. So, yeah, of course, when the numbers are good, people say, oh, it's China numbers, they're fake. And when they're bad, they're like, oh, look at China, look at China. So take it with a grain of salt, I would say. Then, upcoming week on Wednesday, we have, of course, the Fed meeting. And currently, 25 basis points cut, 50 basis points cut, it's a 50-50 thing. The last time we actually saw was the first week actually of September, was 30%, 25 basis point cut, 70%, 50. Now we're back here at 50-50. So basically a coin toss. What do you think will happen, 25 or 50? Let me know down in the comment section below. Previously I said 50, but now I don't know. I have this feeling that they will just go with the safe bet and start with 25, and then maybe the next one they'll do 50. But we'll see. We'll see what happens. Before continuing, I have a special offer here, of course, a sponsor of the channel as well. So Seeking Alpha, on October 1st, the price will increase to $299. So if you click the link down below, you can get $25 off. And of course, you have a 7-day free trial for new subscribers only. If you don't, and you do it after October 1st, then you're going to just pay the premium price. So if you want to try it out, you want to support the channel, do check it out down in the comment section below. I've been using Seeking Alpha even before they offered to sponsor me. It's amazing. Yes, you don't have to agree with all the pieces that get written on there. You can comment. There are some great writers there. Emir, for example, is a writer on Seeking Alpha. Great articles. So yeah, that's one way to support me, and that's one way to support your investing journey as well. Because I know sometimes you see some interesting pieces, but since you can only read 3 full ones per day, then it limits it, and this basically fixes the issue. So if you want to help yourself out, do check out the link down below, and if not, that's completely fine. Let's continue. Anyways, let's talk about risk. So by the way, Howard Marks, incredible investor. Check out his YouTube channel, or Oaktree's YouTube channel. They're not YouTubers, they're huge investors. We've talked about them in the super investor videos. But the most recent one that I've seen is about risk. How do you manage risk? What is risk? Etc. etc. So I started off with this. I put this quote here. There are many quotes and stuff like that. So we'll discuss all of that. Risk is the ultimate test of an investor's skill. Because eventually when you look at the returns after 5 years, 10 years, 20 years, 50 years, you see the returns. But does it tell you the full story? How much risk was he exposed to? Or how little risk was he exposed to? When things go well, when everything goes up, then okay, smooth sailing, right? But then when we have crashes such as the March 2021, horrible bear market in 2022, that was, I think, 2022, or maybe a Black Monday like August 5, that's basically when you look at investors and like, oh, let's see if they slip up. Let's see if they suddenly panic sell or not. Those are the moments where basically great investors or good investors are made. I'm not saying I'm perfect, far from it. I've made my share of mistakes, and I will be making mistakes in the future. But I do think that I've learned throughout the years that just because you see your portfolio in red does not mean that you are wrong. So sometimes you are, because sometimes you just made a bad investment, and I've made those. But most of the time, it's just the market over-exaggerating or over-reacting on a specific thing. So he gave us a couple of scenarios. We've got scenario number 1, manager and the market, they're both up 10%. When things go well, and when things go, well, slightly less well, you're both down 10%. What's the point in that? No point in investing with that manager. Option number 2, you've got a manager when things go well, he's up 20% when the market is up 10%. So that's great. But then in a downturn, he's down 20%, but the market is only down 10%. So yeah, you haven't done much here either. Option number 3, or scenario number 3, market is up 10%, you're only up 5%, but when the market is down 10%, you're only down 5%. It's a little bit better, but also not worth your money. Then option number 4, that's already a pretty good one. So market is up 10%, manager is up 15%, and then when market is down 10%, you're also down 10%. So you're making money here. So that's already a good one. But he basically thinks that option number 5, or scenario number 5, is what characterizes him or Oaktree. So market is up 10%, manager is up 10%, but when market is down 10%, manager is only down 5%. So the focus here is on the downturns. Being better, or making sure your portfolio is better prepared for market downturns. And me personally, I, of course, with the holdings that I have right now, this will not happen. As you've seen throughout this series, when the markets are red, let's say the market is down 2%, I will probably be down 4 to 5% because of the stocks that I hold right now and because of the environment that we're in. But when the market is green, then as you've seen, I'm up 6%, the market is up 1.5% or something like that. So my focus, of course, for the future is to make sure that when the market is down 10%, that I will be down 5%, or I mean the equivalent of that, because I do think that that's when you will be making more money, or at least lose less money, but then again, you only lose when you sell. But when you have market downturns, you want to be down less than the overall market. Plus, you also want to have way more cash than before because you can take huge opportunities, right? That March 2020, okay, it was an easy time to be an investor because everything you touched turned to gold. But even at the end of 2022, at the end of the 22, that's basically when you had to buy Tesla, when you had to buy Amazon, Meta, Google, Nvidia, stuff like that, because everybody was scared, oh, we can go lower, we can go lower. But that's where you need to be greedy, when you need to have some cash on hand. But yeah, these are the 5 scenarios. Scenario 4 and 5 is basically where you want to be or where you want your manager to be if you're paying someone to manage your money. Then he goes on to ask a couple of questions, philosophical questions maybe as well, but I think this one is a pretty good one. So is risk quantifiable in advance? He says, and to be honest, it made me think, and well, I agree in the end, but do share your opinion down in the comment section below. Is risk quantifiable in advance? And even after the fact, he says that risk is still not quantifiable, even in hindsight. Because yes, you could calculate risk, but it's still a risk and there is still probabilities of things going the wrong direction or the right direction. So is it quantifiable? No. And even after something happened, you cannot say, oh, that was the risk for sure. You cannot be certain that this was the reason why, or at least not 100%, maybe 99%. But then again, I think it's something you have to think about. I mean, even now, when I said I agree with it, I still have some conflicting thoughts, let's say. But it's an interesting thing to think about. Then, of course, this is the 2 scenarios where you hopefully you know the answer. So one, buying at the high and seeing it decline, selling at the low and missing out on the recovery. What do you think is worse, number 1 or number 2? Write it down in the comment section below. I'll give you a couple of seconds before I answer it, but it's pretty straightforward, right? It's the second one. It's selling at the low and missing out on the recovery. Now you're going to say, why is that? Buying high and seeing decline is also not great. Yeah, true. But if you bought a good company, then eventually, okay, it might take a long time, but eventually things will recover. Things will recover. But selling or buying something and then selling at the lows and seeing it recover, that's worse, because that's where you lost. You were down 40%, you sold when you're down 40%, and now the stock is going up 30, 50% or so. And what have you done? Okay, maybe you invested in something else, but in that specific scenario, you lost. You lost big time. Moving on to this could actually answer this question, right? Is risk quantifiable in advance? Talking also about probabilities. Even when you know the probabilities, that doesn't mean you know what's going to happen. Talks about the example in backgammon, right? It's pretty straightforward, the probabilities. When you throw the dice, 6 sides, 2 dice, 2 die. Let me know down in the comment section below. But just because you know the probabilities, just because you know that the 7 is the most common number, does not mean that, oh, I'm going to throw 7 now. No, you can be certain that you're going to throw 7, but suddenly you throw 1-1 or 6-6, which of course is the lowest probability because it's only 1 out of 36. So yeah, it makes you think. It makes you think a little bit different about investing in risky assets. And yeah, talking about that, we have of course risk on market environment and risk off. But is it really risk off? Because in a risk-off environment means that, oh, what? The risk is gone? No, the risk is always going to be there. So this risk-on versus risk-off market is quite strange, because at the end of the day, it just doesn't make much sense, right? So risk is low when investors behave prudently and high when they don't. That is true. When you think that, oh, everything is green or everything is red, so in the case of everything is green, you can start investing like it's a casino, not very, very smart. But when things are bad, so let's say in 2022, bear market, that's when you suddenly make, well, decisions that you took your time, you did a little bit more due diligence because, well, markets are red. If I make a mistake now, I'll be even more red. My portfolio will not be doing well, etc., etc. It's the same. I gave the example, I don't know what city it was, but they removed all the traffic lights. And you would think, oh, you remove all the traffic lights in an area in a city, lots of accidents will happen. But no, because drivers perceive this situation as higher risk, they all started to drive more carefully. So yeah, the opposite happened there, and the same here could be said with investing. Moving on here, riskier assets equal higher returns, right? We've heard that one before. Oh, it's a risky asset, so that means I should expect higher returns. No, if that was the case, then it would not be a risky asset, correct? Because we just made that assumption that, oh, risky asset, higher returns. But if that was the case, everybody would be investing in those assets because you get higher returns. So that's already a false statement. Risk just means things are uncertain. And that's true with life. You don't know what's going to happen tomorrow, next week, next month, next year. Macro environment, macro specialists, financial educators, experts, they don't know either, right? That's the whole thing. Nobody knows. We don't have a crystal ball. Palantir, I mean, maybe, but no, we don't know. We don't know, and that's the thing here. Risk just means things are uncertain. And so to come back and conclude maybe bottom line, all of this, yes, to me personally, my portfolio, is it a risky portfolio? For some, it is more risky than others. For me, no, I chose this portfolio because I think that the positions in my portfolio, again, I think it's about probabilities, about risk management, etc., etc. I don't know what might happen in the future, but I'm putting my money in these positions. Doesn't mean that all of them will work out. If the top 5, top 6 work out, as you've seen right now, that could be enough. But again, saying, oh, your portfolio is very, very risky. I've seen these comments in the past. You should be having less riskier stocks. Again, what does it mean? Less riskier stuff. Do you know what will happen with that specific company in the future? Do you know what will happen with the economy in the future? No. You make assumptions, and based on those assumptions, you make those comments or you buy these types of stocks. That's it. I make assumptions, I make my bets, I make my bed, and I have to sleep in it as well. So that's why my portfolio looks the way, well, the challenge portfolio looks the way it is, and why my main portfolio looks the way it is as well. Yes, this portfolio is more risky, let's say, or has more positions where I've made more aggressive assumptions than the main portfolio. The main portfolio has Amazon, has Meta, has Mercado Libre, bigger companies, stable companies based on the current information that I know. So yeah, that's for me the main difference. It was a different type of video that I've made right now. Hopefully it's one that you can enjoy, you can learn from, and hopefully we can have some conversations in the comment section below. If you enjoy this type of videos, like, subscribe, do all of that, and I'll see you all in the next one. Bye-bye.